Hi, my name is Dharmo Soejanto. I'm the Chief Investment Strategist for UOBAM Digital Solutions. This year, both bond and stock markets have been volatile as investors were spooked by rising interest rates and high inflation. The root of this inflation has been more supply chain disruptions, be it because of COVID lockdowns in China or the Russian and Ukraine conflict. As such, we believe inflation pressure will likely begin to ease by later this year or early next year. Once markets are confident that the Fed would pause its rate hike, equities and bonds will likely perform normally again. Although fixed deposit rates are rising, in today's high inflation environment, they are not likely to rise fast enough to preserve your spending power. Not only are basic necessities like food and electricity costing more, but mortgage and loan rates are also higher. Being invested is a good way to try counter these high cost pressures and avoid dipping into your savings. Over the long term, equities can be an effective inflation hedge, as businesses are usually able to pass on higher prices to consumers. Other good inflation hedges include investments in real assets, such as properties, REITs, or infrastructure assets, and commodities. These sectors stand to benefit from rather than being disadvantaged by rising prices. Yes, the fixed rates that bonds pay become less attractive when interest rates rise, so their prices will tend to fall. But different bond sectors can outperform in different economic situations. Lower yielding government bonds can help deliver positive returns even in the event of a recession, whereas higher yielding bonds do well in a slow but still expanding economy. At the moment, short-term high-quality corporate bonds are offering almost 4% yield, stable return, and are not subject to much interest rate risk. This is a pretty attractive return risk profile, especially in a volatile market. One of the biggest global trends today is climate change. Many countries are aiming towards carbon neutrality by 2050. This means that there will be many changes, be it in regulations, consumption patterns, or business practices that are unfolding now and into the next few decades. This would translate to business opportunities and risk for businesses. As an investor, you should consider capitalizing on the businesses offering ESG opportunities and avoiding businesses that are facing ESG risks.